Measured against a basket of other currencies, Canadian dollars, Chinese renminbi, Mexican pesos, the euro, etc., the U.S. dollar increased sharply in value in the fourth quarter of 2014 and the first quarter of 2015. Like many others, you may be wondering how the strengthening dollar will affect your investment portfolio and whether or not you should rebalance your account based on the strong dollar. It's not such an easy answer. A rising dollar negatively impacts raw material and energy suppliers and contributes to downward pressure on commodity prices such as oil. A strong dollar makes foreign imports more competitive and U.S. assets more attractive to foreign investors. U.S. bonds historically outperform international bonds when the dollar strengthens. Small-cap companies that sell domestically are not impacted by the rising dollar and will probably perform better than large-cap companies that rely on international sales. About 40% of the revenue of the companies in the S&P 500 comes from overseas. A falling dollar should strengthen earnings from overseas operations, but will reduce the value of foreign holdings. Historically, the dollar has gone through periods of strength and weakness relative to other countries' currencies, with slightly negative correlation to the subsequent performance of the U.S. stock market. From 2001 to 2008, the dollar weakened and was in a strong downward trend relative to the basket of currencies. International stock markets performed better than the U.S. stock market during this period. From 2012 to 2014, the dollar slowly strengthened, and U.S. and international markets performed roughly in line with each other. Since June 2014, the dollar has increased more quickly, and U.S. markets have outperformed international markets. Currencies are the largest liquid market. Companies use the currency market to hedge price risk in the production of goods and services and the purchase of inputs and sale of products. At the end of the day, like any market, the performance of the U.S. dollar is largely driven by supply and demand. With the U.S. Fed poised to decrease the supply of dollars by increasing short-term interest rates, and the U.S. economy appearing to strengthen relative to the rest of the world, odds are good that demand for dollars will stay high and U.S. assets will benefit from this tailwind.